Welcome to the Founders, Funders, and Friends podcast, where we interview entrepreneurs, investors, and the innovators building the future. Each interview features a special guest in conversation with studio management founder and managing partner Alap Shah, recorded in front of a live audience in New York City. Founders, Funders, and Friends is presented by Studio Management, a data-driven asset management firm investing across public equities and venture capital. Ankur Nagpal. On this episode, we are thrilled to welcome Ankur Nagpal, a dynamic entrepreneur whose journey from Bombay to the United States has been marked by remarkable achievements. Ankur began his entrepreneurial career by building Facebook apps in his dorm room, generating significant advertising revenue. After moving to New York, he started teaching marketing courses online, leading him to create Teachable, a platform that empowers creators to share their knowledge. In early 2020, Teachable was acquired by Hotmart. With a team now of over 150, Teachable continues to thrive under Ankur's leadership. Ankur's story is one of innovation, perseverance, and a passion for education. Please join me in welcoming Ankur Nagpal.
Really appreciate everyone making it out, and welcome to the space. Going to spend a few minutes just quickly talking about myself and the firm, as well as just giving a quick kind of outlook on the macro environment and what we're seeing today. And then obviously we'll spend the bulk of the time getting into the chat with Ankur and understanding his journey. Really quickly, my background started in consulting, spent some time in private equity, and then was at two big hedge funds, first Viking and then Citadel. During that time period, was using all the tools like Bloomberg. About 12 years ago, left to run my own fund. And as I started that process, had this fascinating insight around the fact that the tools I was using were really bad, and they were making me need to hire a lot more folks, and they were really slowing down my workflow. And so took a very long detour from starting a fund to build a startup to essentially build those tools. And that business was called Sentio. It was first and foremost kind of a search engine for finance, but was also a lot of alternative data analytics to make better investment decisions. And I was dog fooding that from kind of day one, and that was really the most fun part, building it for myself. We did eventually kind of go out and raise $60 million, built a big team, got a bunch of clients, and then sold the business last year to our competitor AlphaSense. So it was nice to be in kind of a full cycle founder journey from an idea and a couple people in a room to like a team of 300 plus and an exit, and learned a lot during that time period. At the same time, Johnny, me, and a couple other friends started a business called Thistle, which is a food technology company. And the idea there was same, kind of scratch our own itch. We were just not eating as healthily as we wanted. And the easiest way to fix that was to have something just show up at our door a couple times a week, ready to eat. And so Thistle is still a business that we're running. We launched in New York last year, and would love everyone to check it out, thistle.co. It's the easiest way to kind of just put your diet on autopilot. But, through those experiences, spent a lot of time scaling a business in B2B SaaS, as well as scaling a DTC business. And so I've kind of had a good sort of experience in both those realms. We bring that same experience to our own investing from a venture perspective today. But the thing that we think is most unique in what we're able to bring to the table is first, that real deep empathy of having sat in the seat, starting from scratch and building a team, raising money, going to market. And so really can help with that. And then the other side is we do run, the biggest part of our business is on the hedge fund side. And so we spend a lot of time looking at data, a lot of time really focusing on fundamentals of a market and what's happening competitively. And that's something we also like to offer to our portfolio companies around that same intelligence and all the data sets that we're using to really understand what their competitors are doing. So that's really quickly on me and Studio. To pivot to the market, I think the thing that since I've been doing this series for the last 18 months, we've been in a very interesting cycle where, we had very, very go-go markets when it came to tech in 2020 and 2021, especially driven by a lot of stimulus and the fact that we had inflation that was very low. It was essentially zero interest rates. And really quickly, the way that you think about valuing a business is as a discounted cash flow. So all the cash flows from today to let's say 20 years from today. And the further out you go, the cash flows are worth less. But if you're dividing by zero or a really tiny number 20 years out, a cash flow 20 years out is worth almost as much as a cash flow today. And that meant that when we were in a zero interest rate period with COVID, tech stocks, especially stocks that had very long duration. You didn't make any money today, but in 10 years, 20 years, they're going to make a lot of money. Those things really were bid up really strongly. And then what we had happen was essentially because of all the stimulus we put into the market, for the first time in 30 years, inflation actually went up in a serious way. And there was a big debate in late 21 and most of 22 around, was this inflation like a new plateau? We're going back to the old world where inflation was a constant problem, or was this a transitory thing? And there were a lot of interesting signals around, hey, China used to be very deflationary as it entered the global markets for the last 20 years, and that stopped. Is this now something we're going to see more inflation? That was one thing folks were really worried about. A second thing was just labor getting more power again, and the third thing was supply chains really needed to be rebuilt, nearshored versus what we had in the past. And so all of those things really had a lot of folks wondering, shoot, are we in a situation where we have higher inflation for a lot longer? And then finally, with the green energy transition, we had a lot of folks saying, hey, we're actually going to need to invest more and we're going to have less oil. And that's also taking costs up. And so there was a strong contingent saying, hey, we're going to have higher inflation for a while. And that really, that hurt the market overall, but it hurt things that were really long duration, high growth the most. And venture startups are the apex thing when it comes to really high duration, large growth. And so that's why, valuations really tumbled. The good news is over the last 12 months, the jury's a little bit out, but for the most part, it seems pretty definitive now that, we're unlikely to go into another wage price spiral where we're going to have nasty inflation for many years. It does look like most of what we saw over the last 18 months was a function of just a lot of stimulus passed through all at the same time. Supply chains being rejiggered, and the fact that everybody wanted goods and people didn't need services, and our supply chains weren't ready for that. And now, as we've adapted, the world has kind of gone back to where it was before. We're actually seeing inflation come down pretty nicely. It's pretty close to trend at this point. And now the other interesting thing is with the US being in the situation that it's in, we just have a much more robust economy than the rest of the world structurally. We also put more stimulus through during the pandemic. And that means that, we have very healthy GDP growth right now. On a nominal basis, it was 9% last quarter, which is kind of eye-popping. Whereas the rest of the world most of the rest of the world, especially Europe and Japan, are slowing down very hard, China as well. And so that means that energy prices are coming down. That's going to be a big boost to US growth. There's still a lot of questions around what happens next year, and a lot of folks are worried about a potential recession. Our outlook today, at least, is that I think we'll see a slowdown, but we don't expect a recession. We still have a very, very robust labor market. Inflation is coming down. There's stimulus still coursing through the economy, and I think the thing that folks forget is next year's an election year. They've typically, election years are usually very good years for the market. It's very unlikely you see big slowdowns in election years because the party in power typically sets it up so that there's a lot of stimulus that goes through the economy. So I think we're in a good situation there as well. And the last thing is, usually the Fed would not want to sort of put their finger on the scale when it comes to the economy in an election year. We're in a very unique election this year. I think it's fair to say that most folks on the center, let alone on the left, are really afraid of another Donald Trump presidency. And so I do think if we see a big slowdown in the market and inflation isn't bad, that the Fed will cut more aggressively than it otherwise would. So I think all of that puts us in a pretty good position for an interesting year, but a lot can change pretty quickly. So that's kind of the quick high level. Happy to take questions on any of that at the end, but really want to jump into it with Ankur and understand a little bit more about your journey. So I'd love to just understand a little bit around how you started, childhood, and like what brought you here and how you started Teachable.
Yeah, absolutely. Firstly, thank you for the macroeconomic lesson. I feel much smarter now. Cool. So my journey started like maybe some people over here. I never grew up in America. I'm from India. I grew up in Oman in the Middle East, and my dad always had this vision that go to America, study, like live a life for yourself. And like any good Indian kid, I had two paths. I could either be a doctor or be an engineer. So I came to the U.S., went to school in Berkeley, and thought I wanted to be an engineer, and that lasted approximately one summer. I interned at Amazon, and my team was responsible for one page in Seller Central, like this entire group of individuals responsible for one page. There was no better way of feeling like a cog in the wheel than literally, having such a small role. But that got me started, building silly little apps on Facebook. This was, 2008, where you could throw a sheep at someone or send someone a gift or answer a personality quiz. And by the end of that summer, I started making, $10 or $20 a day. And that was the most liberating money ever, because I realized I can do shit on the internet and make money. Like, why ever get a job? And then just sort of built different businesses from there, of which Teachable was the most significant.
Awesome. Could you tell us a little bit about Teachable and what you guys did?
Yeah, absolutely. So started Teachable, what became Teachable in 2013. I just moved to New York City, was teaching courses in person and online. And it felt like while I could teach courses and I saw the market opportunity there was no way of selling these courses on my own website. I had third-party marketplaces that controlled my pricing. It was very hard to build a business. So we ended up building the first version of what became Teachable as a side project. It was something for me and my buddy. Got to the point where we're making a few $1,000s a month, and 6 months in, we're like, wow, this could be an actual business. Then went the Silicon Valley route, raised venture money, and kind of went from there. But what's interesting is that at no point was it intentional. There was no big grand vision. It was just a side project. It worked 1 month, a little bit better the next month, a little bit better the third month, and then you get addicted to that progress and built the company.
It's generally, that's the beauty about startups is like you do that for like a few years straight. You look back and you're like, wow, how are we here?
Yeah, absolutely. A lot of people think, it's some grand vision or wait for this giant idea. But for us, it was just lots of small ideas compounding on top of each other.
That's fascinating. I think you also have a very interesting story in terms of your financing strategy versus others in the space. Would love to hear about that.
Yeah, I think honestly, we got kind of lucky in that Teachable was a simple business. We help people sell mostly digital products. Our margins were very good, like software business margins. And as a result, we never needed a ton of money. Like, we had to raise money up front because we had to hire engineers, but we burnt very little money over the course of running our company. So when I sold the business, we had close to $9 million in the bank, and we'd raised 12.5 total in our entire lifetime. So there were a lot of times where, we'd accidentally break even for a month. Our burn was like 50, 60K a month, super, super manageable. But as a result, I was able to control the board until exit, personally own more than 50% of the company, and kind of just didn't have to take shit from anyone. It was awesome.
Yeah, that's amazing. If you can make it happen, it's usually pretty difficult. It sounds like there were some unique elements of your market and the TAM that allowed you to do that. If you want to talk about that a little bit.
Yeah, absolutely. One, we tried to spend money on paid marketing, but we never could get a high enough ROI. So we always had to be very inventive in how we marketed and grew our business. We stumbled upon an insight pretty early on where our most successful customers were typically creators. They in turn had an audience that were also our customers. So that became our unique strategic insight that other companies did not have. And we just leveraged the hell out of that. We did all kinds of things from affiliates to large events with other creators. But if we made our creators sound good in their audience, we would acquire our next 1,000, 10,000 customers. And that insight allowed us to scale without sales, without traditional paid marketing, and sort of is what we just, rode to grow 5x, 4x, 3x, 2x year over. Those are the first 4 years until we ended up selling.
Also, I assume you were very, very early in the creator economy, which is part of.
We didn't know that there was no creator economy. We got lucky. As we were doing this, all the creator platforms started spotting up. But again, it's why I tell people don't discount the fact luck had it. We were very lucky. Good things happened to us by being in the right place at the right time.
That's the beauty of being able to experiment. It's you start in one place, you see this pocket of growth, and then if you're able to move towards it, that's a lot of what a startup is just every day, every week, kind of course correcting and listening to your team and the data to say, hey, this is potentially where we should go versus having
Yep. I strongly believe when you start out, it's helpful to solve a problem very well for a small group of people, make them super happy, and then go from there. Because when you cast too wide a net, I think it just gets very hard. It's better to make a few people super happy than a large group of people kind of happy. And again, we got fortunate as the market grew, but if the market didn't grow, we would have grown what we did, right? Like you always are in control of that. You can always expand horizontally. And, again, had we not exited when we did, we probably would have kept trying to broaden our market as well.
Makes sense. How big was the team at the end, and any advice for other founders in the room in terms of team building and growing a team?
Yeah, I mean, so firstly, like, don't do what I did. I didn't know shit the first time around. But I think one of the biggest learnings or the biggest differences doing it a second time around is the first time I had like this insecurity of like, oh, I don't know anything. I should like talk to other people, read these books, and like listen to all these experts. And while it was somewhat helpful, I think it ended up being more damaging than helpful, because I would do things not because they were like congruent to how I am as a leader or how I am as a manager, but because this book told me I should do this. And as a result, like, after seeing a full cycle running this company, I realized a lot of these so-called experts, they don't know that much, really. Like, they all have had a few more years of experience. They've generalized that as like lessons for everyone. And the big difference this time is actually trust my instincts a lot more. And my overall message to first-time founders are, chances are your instincts are probably as good as a lot of the other experts. So just sort of listen to yourself more. And that's something that, I've internalized this time around. But back to your original question about like business size and stuff, when we exited, we were at about 120 people doing about 25 million when we signed the deal. It was right when COVID happened. So we doubled to a 50 million ARR 3 months later. And I ran the company till we were doing about 60 million a year, at which point we're close to 200 employees.
How was the experience working with the acquirer?
I love the people we sold the company to. I didn't spend a long time trying to shop the company. A lot of people will like hire a bank, do an M&A deal. A private equity company, General Atlantic, set us up on like almost like a blind date of like, you guys meet each other. If you like each other, you can like work together. And I really liked the company that we sold to. They're called Hotmart. But the thing that I appreciated the most is they're a founder-led company. The founders have been around for 11 years. They were in Brazil, so raising money was really hard. So their first round of funding was $400,000. Their second round of funding was $100 million 10 years later. So they learned how to bootstrap this massive business. So they're just good people. So I indexed on finding good people versus the single best price. And yeah, it was really good, because even when it came time for me to walk away, they were super understanding, knowing that, I'm a founder, I'm not an operator. And once you've bought my company, I'm it's not fun for me anymore. So I'm going to bounce.
It's really funny how that works. It's just like, even if you're doing the same thing, it just feels so different.
And it's funny because people are like, oh, how did selling the company change your life? It didn't really, but when I quit my job, it changed my life entirely. But when I sold the company, I had money in the bank and I was living the same life, nothing changed. And it's just sort of dorky, but I have this like Aura ring, some people have it, but I have data to see like my sleep and like resting heart rate, all that shit. As soon as I stopped doing my very stressful job of CEO, all my numbers like were better, right? Like, you have all these people who are like, oh, I need to like not drink or have a dark room. Nah, just quit your stressful job and do whatever else you want.
Well, that's particularly ironic, because basically founders are all wearing Aura rings.
Yeah.
That's also ironic because, I sold my company and quit my job, and nothing changed in my stats. So maybe I'm doing something wrong.
Well, it probably means you were less stressed than I was, but it made me realize by the end I didn't really enjoy my job. It felt more like this like trap I was in a lot of ways, where we were, like, I love starting companies. I love being a founder. Operating a 200-person company, it's a completely different personality type and thing.
It's fascinating. Like, this is why kind of the 0 to 1 folks versus the builder folks often tend to be different, because it's a different personality type. When you're over like 100 employees, like a huge part of your job is just managing the psychology of your direct reports. And it's just a completely different skill set. It's one I didn't have.
Yeah, and I had to spend all my time convincing people to do the shit I knew was right. And, you had to have meetings and the whole process, it just felt like I would go in, work a long day, but feel like I got nothing done. And it became stifling by the end.
Okay, so pivoting post Teachable, you started a venture fund. Would love to learn a little bit about that and that journey.
Yeah. So after I sold Teachable, I told myself never run a startup again. Like, I ran out of the country. I went traveling the world for 2 years, and I was like, what job can I do that keeps me like sort of relevant, yet I can do not working that hard? No offense to anyone who's an investor. But But yeah, I ran a venture fund on the side. It was in a lot of ways an amplification of my money because I made a bunch of money on the exit. I was my own biggest investor at 30% of my first fund, 20% of my second fund. And it felt like a great way of not having that stressful job, yet being able to like talk to other smart people, inventing the world and be somewhat relevant while like, bouncing from country to country. And it was really fun for that period of my life. But when it came time to build something, I felt that from a personality type, I'm a builder first, and an investor didn't give me the same sense of satisfaction. So kind of took a back step and then started another company.
Okay. And during that time period when you were focusing on VC, it's interesting to be on the other side of the table. Would love to understand a little bit of the unique insights you had, especially around what it takes to be a founder as the person kind of funding the founders.
Yeah, absolutely. I mean, as an investor looking at founders, it's the first time I actually like internalized investor math, right? Like as a founder, you always hear, investors, like they really need a few companies to like work out. But my fund one is 4 years old, and one company is going to be the difference between us having a fantastic fund and like a kind of good fund. Because we have one company now worth 3 times what our fund size is, and like 80% of our companies are going to be worth like 1x or 0x or whatever. And when you internalize that math, you kind of understand why investors are sometimes douchebags about like market size and like really having this like, not like 100 million but 10 billion outcome, but like that's sort of venture math. So internalizing that made me sort of have empathy for investors. From the other side, in terms of founders and what I looked for, it was typically people with raw horsepower, which might be like just raw intelligence or work ethic. People that were fast, like at least for me, I'm pretty fast as a founder. I like rush to doing whatever can be done next week, today. So I really worked well with founders that were really fast. The third thing is, it's hard to find a word to describe this, but founders that are good at convincing people to do shit. Because as a founder, you have to convince people to use your product, to like give you money, to join your team. So people that were convincing. Those are sort of the 3 things that I think I identified was what I looked for in founders.
Makes sense. And then now you decided to kind of sunset the fund and you're focusing on a new startup. I'd love to hear about that.
Yeah, so I went from I will never start a startup ever again to starting a new company. And I think it's what started happening, and like I think some people can relate to this, is nostalgia is a bitch. Like after a while, I just started remembering the good times. I forgot all the bad times. I was like, wow, the early days were so fun, right? It was so nice to build something. And yeah, after 2 years, I was like, 32 at the time, sitting Brazil or somewhere, and I'm like, I'm too young to be doing this shit. I'm too young to be living this like kind of nomadic, like in the moment, like existence. And I was like, I kind of want to grind and build something dope with a group of people I care about, which is why this company's in person and all of that. I just missed that sensation and felt like my 30s were the time to do that. So decided to come back here, hired a team. The mission we wanted to work on was very clear, because while selling my last business, in the process of selling the business, I ended up hiring lawyers and accountants and all this shit to learn how the financial system works in America. And the US tax code is just completely fucked. But in how fucked it is, there's a lot of opportunity to show people how it works and how they can take advantage of it, even people that don't necessarily come from like generational wealth. And the business ended up being a version of that.
Fascinating. So help us understand how that works, like some of the services that you provide.
Yeah, so going back to like not like picking a target market and solving a problem for them. Today, the target market we're solving a problem for is business owners who work for themselves in typically 1 to 10 person profitable businesses. And we help them save a lot of money on taxes by setting up for today retirement plans, either a solo 401k, which is a very effective retirement plan for anyone self-employed, or if they're making $500,000 or more, something called a defined benefit plan, which is an even more complicated plan, but it does this for them super well. And that's a problem we're focused on solving today. In the next 10 years, I think we would like to build a financial institution from the ground up. I think Schwab is sort of a company I look up to and how they've done it, but we're going to start one product, one demographic at a time and go broader from there.
That makes a lot of sense. I think one of the other things that you referenced before was tax savings upon selling a startup. if you want to chat a little bit about QSBS, and then I can give my impressions as well, since I'm not sure everybody in the room is aware of the qualified small business stock exemption, which is a phenomenal opportunity for founders.
Yeah, it kind of blew my mind, and also it doesn't make sense why the government gives such a giant tax break to people that are already kind of wealthy. Like, it doesn't really make sense, but that's
incentives.
That's the US, right? But yeah, when I was about to sell my business, I found out that if you're selling your company as a startup founder, employee, or investor, and you own your shares for 5 years, and if the startup had less than 50 million in assets when you got the shares, which most of y'all have with your startups, there's no taxes due on $10 million. No federal taxes, no New York taxes, which is pretty fucking wild. And 41 states have no state taxes. And it's this weird dark art where you can then take that and multiply the $10 million benefit to no taxes on $20-30 million. But that's when I realized this tax code isn't fair. Like, I know founders who never knew about this, and they ended up, just missing out on this. And most employees have no idea. And most companies don't set their employees up the right way in order to take advantage of this. And, this just made me realize there's so much shit in this tax code that people don't know, and one, we should be talking about it, and two, give tools to make this accessible so other people can take advantage of it and not just the 0.1% or whatever.
Right. It's the other important thing is it needs to be a C corp. So if you're an LLC, it doesn't work.
Yep.
But
most tech startups are.
Exactly. So, if you're taking venture dollars, they're pretty much going to require you to be a C corp. But the other thing to keep in mind is when you do actually go to exit, as you referenced, you can essentially create trusts and put some of your shares in trusts and multiply that 10 million to be a lot greater.
Or give them to family members. Like with my new company, I gave some shares to my mom, my dad, my brother, like all of that. The actionable thing for anyone that's an employee is if you have the option to buy equity in your company pretty early on where it's not worth a lot and it's a few pennies or whatever, it's super worth doing because you need to hold shares for 5 years and your clock only starts once you buy the options. So what we did with my new company is we gave everyone shares up front just to get their clock started as well. So again, who knows if anything good happens with this business, but if it does, I wanted to make sure my employees were well set up, which we didn't do the first time, not because we didn't want to, we just didn't know.
Yeah, it's quite an incentive. Last year, they were certainly talking about going after it, but it looks like at least for this revision, it did make the cut. As you said, it remains to be seen how long it lasts. Exactly. Any other kind of parting thoughts for the audience?
No, I mean, I think you covered a lot of the journey. I mean, I think overall, my doing this a second time around, the sort of things the one thing that I guess it's important to cover is it sounds silly, but one of the other things I regret, it's not a big regret, but I wish I did last time was kind of enjoy the moments more, like dumb shit. Like I wish I had more pictures, we had so many great times as a team. We had crazy parties. We did so much fun shit. I wish we had more pictures. I wish we took more time to be like, man, we're given money by strangers to do shit on the internet that we were doing for fun when we were 15 years old anyways. So just reflect, enjoy the journey. It's kind of ridiculous we all get to do this. So that's something I'm trying to be more conscious of this time.
That's great parting words. Let's open it up for questions.
About the world, the economy, the markets, all of it. What space would you start in?
I wish the answer was subjunctive. The answer is I'm actually doing that. I can't stop starting new things. I'm 3 new startups I'm working on. The answer I'm going to give you is particularly kind of a waffly answer. I'm the thing I care about most, in terms of what I build and what I'm best at, is building tools, especially software, to really allow humans to be as productive as possible. Sentio was that for my personal financial productivity, where I was using Bloomberg and Excel and FactSet and 3 custom tools, and Sentio just did all of that at once. And so now I'm building this thing called Executive Function, which is that for not my financial productivity, but for my general purpose productivity, a lot of which is around chat and email, but a lot of which is also around things like WhatsApp and SMS, and not work, but personal productivity and personal CRM. So I'm building kind of a new tool that does all of that. I'm very, very excited about it. I've never been less convinced of what's going to happen. With Sentio, I was like, okay, there's a very clear niche here. I'm going to hit it. We're going to raise money. We're going to build a team. Whereas this time, on the one hand, the opportunity is a lot bigger and the speed at which we can move is greater than it's ever been. But the flip side is it really feels like if you're in any sort of software and the closer you are to kind of productivity software, you're just building on like a foundation of sand right now. Because, AI and especially OpenAI, the speed at which they're moving is kind of jaw-dropping. And it's accelerating really fast. We're lucky right now as an investor to be able to invest in the public markets and the private markets. In the public markets, it's very easy. Like just buy Microsoft, buy NVIDIA. There's no way you're going to lose money. On the private markets, it's very tricky. We a bunch of really, really exciting companies we're looking at, the capabilities of what they can do. I mean, like your company is really powerful, but at the end of the day, investing is less about what the product can do. The product is a piece of it, but investing is about, what is the moat? How many people are going to adopt this? What is the revenue model? What is the profit model at scale? And for those things, it's really, really hard to understand what's going to happen because everything is moving at such a fast pace. On the one hand, you can make a case to say that, the average SaaS startup, the average $5 billion publicly listed SaaS startup can be replicated at 10 times the speed today because how quickly AI is moving. And so that means that their moats are lower. The flip side is you can also say that it's going to be really, really hard for startups to take market share from incumbents because the incumbents are going to integrate this content much faster than they ever have. And you're seeing that already with folks like Microsoft, who historically is not in any way known to be a fast mover. But through this partnership, they're the first folks with copilots and things like that. And so it really is an open world. And I think as we have, the next 6 months, 12 months, as new things come along, it's going to continue to become, like, in some cases, much more exciting. But I do suspect the winner-take-all dynamics when it comes to AI are likely going to be stronger than they have been in the past 2 cycles, and they've been pretty damn strong in the last 2 cycles. And so that makes it a lot more difficult. But it's an exciting time, and I think that the thing that if I'm a founder and I'm pitching, it really is about hey, how do I build a moat? And to some extent, the moat is speed, and the moat is data and clients. But the problem is that that's where incumbents, for the first time, this is the technology shift that might be pro-incumbent rather than anti-incumbent. So I swear that they're almost like a planted question for me there, Bosch. Thanks. Ankur, I don't know if you have anything to add.
I am building the business that so yeah, nothing to add there.
Yeah.
Ankur, thank you for sharing. As a founder turned CEO in your first company, you were being a CEO as a founder, having to actually deal with the dirty part of the business, something you look back upon.
Yeah, so very candidly, I don't think I was a great CEO, and it's something I still reflect about this time. Is for the first 2 years, no one is really a CEO. You call yourself a CEO, you're not really doing CEO shit. There is no CEO shit to do. But I think eventually the part that I found the hardest as a CEO is, as a founder, you're a person, right? Everyone you're working with is a human. You know them, you're close with them. Especially our last company, we're all in our 20s, But as a CEO, you kind of have to look at people as resources, for lack of a better word. And that's something I truly, truly struggled with, whether it's performance management with someone that's a close friend, and I'm seeing they're doing the hardest they can, yet they're probably someone better for them. And those were, to me, the hardest parts of it. There were times where it was just soul crushing and stressful. And I'm you know what? I don't want to be CEO. This sucks. I think eventually you get better at that. One, with time. Two, you realize if you think you're being empathetic by not finding the right person in that role, you're actually not being empathetic to everyone else, and so forth. So I think a lot of it was frankly hard-won lessons. But part of me does think that as a founder, at a certain scale, I just don't want to be a CEO, not because I can't. It's just not how I value, spending my time. So I think there's a very good chance with this company at a certain scale, I'll sort of, step aside. But yeah, so it's probably not an uplifting answer, but that's the candid answer, with the caveat that the first time what I found, which changed with time, is that a lot of ego attached to being CEO. I was like, it's my company. How can I not be the CEO? But with time, like the ego sort of goes away, and you realize you'd be totally fine with it.
The AI can be a CEO at this time.
Yeah, exactly.
It's funny, but to some extent, the hardest thing for me was like firing the first person. It like it's so much longer than you should until you realize, yeah, I'm being empathetic to this person, but I'm dragging the entire company down in the process and like endangering, the likelihood of survival of the company by not doing it.
Absolutely. But honestly, you know what? That's good. That's healthy. Some founders scare me. Some founders are gleeful firing people, and that's terrifying.
Yeah, that's fair.
So, question for both of you. Just to slice into the mind of a founder, what are like 2 or 3 problems or pain points or obstacles you guys are currently facing? Want to go first?
I mean, the biggest one is the one that I just mentioned. So much of being a founder is leading your team with like confidence and certitude, and it's just a lot harder. You can fake it, and a lot of people, let's fake it till you make it is kind of what you do anyway. But it's just a lot harder to do that today than ever before because things are changing so fast. And I think the good news still, and what I'm worried about as a founder and as an investor, is that this will change. So right now, being certain around what's happening with software and AI is very difficult, but we are not in a situation where the venture capitalists are saying, shit, this is really difficult to figure out, we're going to put our pencils down. We're still in kind of like this, maybe the first phase where everyone is, I have to, the music is playing, you got to dance. Like I got to deploy capital against anything that says AI or has AI in it. And so it will get much more difficult. And I'm not saying this is going to happen, but I think there's a 30-40% chance it will happen where, the first wave, the returns are very poor, and then the bar to invest gets a lot higher. So I think that that's really the thing that's kind of on my mind as both an investor and a founder right now, is just sort of how do you move really quickly, really aggressively. And a huge part of moving quickly and aggressively is like spending a lot, but part of it is like you just want to also kind of keep it a little bit closer to the vest today than in the past because of what you're seeing. But the flip side is if you do kind of go out there and get an early lead, you can move really fast. And the flip side is like at the end of the day, the only real advantage you have as a founder, as a startup founder, is agility, it's speed. And so AI does give you a hell of a lot more of that. And so it's just a question of how you put it to use. And I think part of it is, we're seeing this with some of our portfolio companies now. It's not just, how do you use it to build product more quickly, but it's how do you get better at go-to-market with it, like sales, marketing, customer service, customer success. All of these things are so easy to accelerate with the content that's coming out. So I think it depends on what you're building. Like at the application layer, it gets a little bit trickier, but I think unfortunately the simple answer is like you just have to go and do it, and then adopt or adapt as situations change.
All right, I'll give you my top 3.
One, better time to think about it.
Yeah, now that I've had to think about it. One, we have 692 customers, and we're pacing for 842 by the end of the month. But we need to hit 1,000. I need to find 148 customers by the end of this month. That's one. SEC is being a pain in the ass. I'm in a regulated space, and every fucking week is some compliance nightmare. Third thing is, this is evergreen, but finding a way to scale my time. I mean, right now, I'm doing every little tactical thing, but in the process, it's getting stretched, and probably need to figure out a chief of staff hire or something that can like give me leverage in my time. But that's the top 3.
Scrappy, and there's other people who like take the fucking check too. So I was just wondering when you guys started out or now, what if there was something you could change going back, would you change the way that you raise money? I know that you said you were able to operate on slim budgets, but what you guys' advice is for
The rule of thumb I was told early on in my first company is take what you think you need for 24 months. And that's, I think, a good number. In this market, I would think twice about turning down money of any kind just because it's hard to come by. But if you need a way, right, because people are like, oh, how do you come up with a number? 24 months of expenses, I think, gives you enough buffer to prove something out. Back in the day, it could be 18. I think now 24 is sort of closer. What do you think?
So I would take that heuristic of 24 months and double it because, that's going to give you even more of a margin for error. But I would answer the question a slightly different way. And obviously, I think coming from different places, your business was very capital efficient. It wasn't highly competitive in the same way. My business was the opposite. The thing about being a founder that I was told this, and as a first time sort of really headstrong founder, I didn't take the advice. I wish I had. But your only job is to make sure your startup doesn't die. If you keep making sure your startup doesn't die for 5 or 6 or 7 years, you'll have a big company at the end. And it's less about like, what is my valuation? How much dilution am I taking at this stage? And it's much more about like, is this a good partner? Is this money going to get me to where I'm going? And if so, become a little bit less sensitive to valuation and just kind of put the capital on the balance sheet because we're in very, very uncertain times. I think the venture market has certainly gotten better over the last year versus the previous year. But, previous year, like there was no money to be had. And so it's really incumbent that, you put away the ego, you put away this idea in your head that like my business is worth this much because somebody else got this multiple or, my competitor got this valuation or my friend got this valuation. It's more just like at the end of the day, your business is worth what the market is willing to pay for it. And, in the public markets, there's 1,000 people bidding on a stock every second on the bid side and the ask side. And so it's a very, very efficient price discovery. When it comes to the private markets and especially comes with the venture markets, it's just usually it's what 1 or 2 investors are willing to see. If you can get 2 investors to play off each other, great. But most of the time it's like, one investor sort of sees the potential for your business. They make you an offer and you largely are either going to take the offer or decline the offer. And so it's really kind of an act of like kind of tamping down on the ego a little bit and saying like, it's not exactly what I want, but it's the money to get me to the next round with a buffer. And so if you just keep doing that and worry a little bit less about the valuation and the dilution, you're much more likely to get to the other side of it. And I think, I learned that process kind of the hard way through the process of building my company and fundraising. But it's something that I often, as someone who's been both a founder and investor, I'm often screening for that. Is this founder going to be reasonable around kind of, the way they're dealing with, existing investors, new investors, and, are they focused on like the end goal, which is, building a big impactful business, or are they focused on like, this is how much my stock is worth and this is how the size of the company I've built, things like that. Doug?
Sure. Follow up in your macroeconomic analysis. One thing I didn't hear you mention was U.S. Treasury debt and the kind of like record levels of that, and also the record levels of interest that essentially has to be serviced. And given that in the past 12 months, we've had a lot fewer foreign buyers purchasing treasuries, there are not that many tools that the government has to actually kind of like deal with this. And like a traditional one is, to actually like raise inflation. So what are your thoughts as far as like how that's going to impact the markets?
It's classic markets where they're just like completely schizo depending on what they want to focus on at any given month. For the last 2.5 months, treasury yields went crazy. Like the amount that the government had to pay for debt went up like 125 basis points to like over 5%, because we were issuing so much debt because our deficit is so high. One of the reasons that our economy is so much more robust than the rest of the world is because our deficit's a lot higher. And it seemed like the market was really freaking out about that, somewhat because like, Japan and China and places like that aren't buying as many treasuries, but somewhat just because there's a lot of supply. But it ends up becoming like narrative more than anything else is the way a lot of these things work. And so I think we overcorrected to the upside. And then you had, a really tame inflation print and the market just kind of forgot about that deficit concern, and now instead, it's kind of like it's party time, and so that's what's happened over the past month, and then I think at some point in the next few months, we're going to have the same thing happen again. Inflation might be a little bit less tame. We're going to continue to run huge deficits, and rates will back up. The other sort of more structural way I would think about it is, for the longest time, I don't want to get into too much history, but neoliberalism came into power and came into being in late 70s and early 80s as a response to inflation, where you had Mideast war led to huge oil spikes, which led to inflation all over the world, and in the process, all the existing governments got thrown out, and right-wing folks all over the world, folks like Reagan and Thatcher came into power, and their mandate was to crush inflation. And the easiest way to crush inflation was to crush labor. And so they crushed labor, and in the process and then the other way they crushed inflation was they really went crazy on free trade. You opened up the global markets. We shipped a ton of jobs overseas, especially to China. And, a lot of ways you kind of hollowed out the middle class in the US and Europe. And, a lot of our problems today can be traced to this neoliberal turn, which started with inflation. But then that whole move, to neoliberalism was essentially called the Washington Consensus, which then we preached to developing markets through the IMF and the World Bank. What has happened over the last 5 years, essentially starting in 2016 with Brexit and Trump, is you've now gone from the Washington Consensus was around austerity. So the government shouldn't spend too much, free trade, make sure labor doesn't have too much power, keep inflation low. And that for a while worked well because the system hadn't done that before. And then, around 2010 or so, 2008, you had the crisis, to some extent caused by that. And then it got worse and worse. There was more and more discontent in the world. And that led to really kind of big things happening like Brexit and Trump being elected. Since those two things happened, essentially what we've had is that Washington Consensus has kind of gone out the door in a lot of markets, especially the US and the UK. And instead, you have what's called the Buenos Aires Consensus, which is like, Buenos Aires means, print a lot of money, spend a lot of money, be like Argentina. And essentially, that's the world we're in right now in the US. Increasingly, we expect to happen in Europe as well, where it's no longer about austerity. Deficits don't matter as much anymore. It's much more populism. People are struggling, so we need to print money to help them, and that's kind of bringing us around to the other side on labor. And so that's going to lead to bigger deficits, as we're seeing. It's only a really huge problem if rates stay high. And so my outlook on this whole thing is our deficits are too high, but I don't think we're going to bring them down because there's no political will. You've got Trump, who is not actually a Republican in terms of like his populism and how he wants to spend money, if you saw the first cycle of Trump. And then you have Biden, who also is, very populist. He's a natural Democrat, wants to spend money. And so we're in a situation where either party wants to spend money, and they're going to keep spending money until they can't. And what will eventually rein them in is the bond markets. And historically, the bond markets have a fit, like they did last month, that keeps happening for a few months. And then you had this happen in Europe, in the UK last year with the gilts, and then they have to essentially stop. What I think is going to happen this time is we have the same problem, but you have this insanely strong countervailing force, which is technology. The biggest driver of deflation over the last 30 years, in addition to China, was just technology was getting more and more powerful. That has continued to be the case, except now it's just, it's an order of magnitude more powerful with AI. And so I think AI will end up being tremendously deflationary. And so I think that probably overwhelms everything else. And so I think we might actually just, make it actually will work out okay. That's going to lead to a whole host of other disconnects in society and our politics around AI. And I suspect we are one election cycle away. So if, 2024 now, in 2028, all we're going to be talking about when it comes to politics is AI and like essentially how you're regulating it, but more importantly, how you're taxing it and how you're essentially compensating the losers in that world. But that's how I see it. Whoever's in the back.
So I think, I mean, one, market size is a big part of it too. Like you think about what makes America unique, right? I mean, I'm an immigrant here, but it kind of has the selection bias of like some of the smartest, most ambitious people from around the world come here. Canada specifically is interesting because like outside of Shopify, they really like it theoretically looks like it has a lot of the same characteristics, but one, it's a smaller population, but I mean, you're from Canada, you know, people like the people there, when they aim to build a large business, it's just a different sort of scale. So I do think scale of ambition is really important, but markets like, you know, India and China and so forth, like you are seeing a large amount of venture dollars. Like when I was running my fund, we did a good amount in India and other emerging markets. And I think when you come to a market that is like hungry and large, you find businesses that grow faster, even though like certain economic penetration is lower. So like India, for instance, I no longer think is an emerging market. It's not fully emerged, but in venture, it's sort of in the middle. So I think it depends on population.
Yeah, it's an interesting question where at the end of the day, there's nothing quite like the US in terms of the size of them. Like if you compare the Europe and the US, they're about the similar size and the similar kind of wealth levels. But in Europe, you got to operate in 15 different countries, different languages, different borders. It's kind of the same zone, but it's not. The US, you just get one market of 350 million people. It's really unique in that sense. The other thing, if you think about it, like the US is the US because it's as large as it is. It's because typically what happens is like economic growth converges, right? The larger you are, the richer you are, you should grow slower. And what we've seen over the last 20 years is the opposite, where the U.S. started with a big lead, and that lead has actually been extended, and especially since the pandemic, the disconnect between the U.S. and Europe and Japan is massive. And so I think a lot of that is cultural, and I think a lot of that is structural, where if you think about all of the giant tech companies that have been scaled in the U.S., if you look at Europe, I mean, I love Europe. It's like I have a lot of European friends I love visiting, but it's not the same kind of place to build technology. Unfortunately, like, I mean, the biggest tech company that's been built in Europe, I think, is Spotify, which is like in this cycle, right? And there's like things like SAP, but that's like a $35 billion company. There's probably like 150 companies that are bigger than that in the US, just in this cycle. And so some of that is having this almost like Schelling point of infrastructure to be able to do it, having that ethos. I mean, I think, let's be honest, like, it's really fun to go to Europe because like, they're working less hard, right? They know how to live life better than we do. I guess we know how to work harder than they do. But a lot of that kind of filters through. The capital is there. The risk of capital in there, like the capital in this country is more seeking higher returns, higher risk. They want to invest in venture. And so I think Europe, that's kind of a very clear thing. I think same thing, Shopify with Canada is similar. I think, echoing what Ankur's saying, India and China are different beasts in that sense because they are very, very giant markets and they are moving very fast. They have that convergence benefit where, they're coming from a much lower level of GDP, so GDP should grow a lot faster. And in a lot of these cases, when you have that opportunity to converge, in a lot of cases, you can just leapfrog technology. So India, for instance, did not have good landline telephone technology. They just adopted 4G and 5G and went straight to state-of-the-art, being able to leapfrog all of that. And so there's a lot of things like that happening. I think China has historically been the poster child of that. I think the problem with China is when it was advantageous for the Communist Party to allow, a form of capitalism to flourish and startups to flourish, they let that happen. But it just happened to be in their benefit when it was early in the cycle and they could do it without losing too much power. Now you're in a kind of a different point in China's growth cycle, and the government, it's harder to kind of keep pushing on the same string and keep doing what they're doing. And so now they've realized, we're not going to be able to grow the way we were before. So what is the most important thing? What is the only thing the Chinese Communist Party is thinking about when they make decisions is whether or not this is going to prolong my power. And so now technology is more of a threat than it was before. It's not driving the same kind of growth. And more of the technology is now being sort of pointed to things that are a little bit more dystopian around control. And so economic growth in general is now a secondary concern for the Chinese Communist Party as opposed to keeping social stability. And so that's naturally having a huge impact on the growth that China's displaying. And I think that's probably going to continue to be the case. And a lot of that, Xi's consolidated a lot more power. And that means that they're probably not going to allow anything like, the freewheeling kind of tech of the past. And that's okay if you're a Chinese investor and you can't invest anywhere else, you're going to keep investing in China. But for most of the world's global markets, capital is very fleet, it's very efficient, it can go wherever it wants. And so, Westerners especially are really kind of scared investing in China. It remains to be seen if that changes. I don't think it will change. I think this is, a longer term thing. And India, on the other hand, is I think where a lot of those incremental dollars are now going to go as, the world's largest democracy, one of the fastest growing countries in the world, very open kind of capital account, very kind of Western British institutions. So, I think that's another market where that's going to happen. And we're also very bullish on India at this point, but, yeah, it's so much of it just comes down to scale, and there is something just very unique about America being America and what we're able to do, and just kind of you have to put all those pieces together. And a huge part of it is just the more tech there already is, the more tech there's going to be. And like in that sense, even New York, I think we have a flourishing tech scene at this point. But let's be honest, it's not the Bay, especially when it comes to AI, where that's really heavily concentrated in one market. So it really is a lot of this is just like kind of classic economics of like network effects in local geographies that's driving it. And I think we've gone way over, so really appreciate everyone's time. Yeah.
Thank you.